The Psychology of Money. The book was written by Morgan Housel, a former finance columnist for The Wall Street Journal. Published in 2020, it aims to provide readers with a deeper understanding of the psychology behind money and investing. The book explores various psychological factors that influence our financial decisions, such as fear, greed, impatience, and overconfidence. Housel argues that understanding these psychological biases can help us make better financial choices and achieve long-term financial success, rather than focusing on complex financial strategies or market predictions. The Psychology of Money emphasizes the importance of developing good financial habits and cultivating a healthy mindset about money. It encourages readers to adopt a long-term perspective, avoid impulsive decisions, and stay disciplined in their financial journey. The book is written in an engaging and accessible style, making it suitable for readers of all levels of financial knowledge. It combines personal anecdotes, historical examples, and practical advice to illustrate the psychological principles at play in the world of finance. The Psychology of Money offers valuable insights into the human behavior that shapes our financial decisions. By understanding the psychology behind money, you can make more informed choices and build a stronger financial foundation for the future. Introduction. You might find it interesting to hear about a tech executive who had a lot of money but behaved recklessly with it. He would show off his wealth by flaunting stacks of $100 bills and throwing gold coins into the ocean with his friends. Despite his initial display of opulence, his extravagant and irresponsible actions eventually led to his financial downfall. This story highlights the central theme of the book. Success in managing money is less about intelligence and more about one's behavior. On the other hand, the story of Ronald Reed, an unassuming janitor and gas station attendant, shows how disciplined saving and investing can lead to financial success. Ronald's modest lifestyle and prudent financial decisions enabled him to accumulate a substantial fortune over the years, leaving a lasting legacy through generous bequests to his loved ones and community institutions. The contrasting fates of these two individuals showcase the profound impact of individual behavior on financial outcomes. In the realm of investing, tales like those of Ronald Reed and Richard Fusconi are not unusual. They illustrate how success in finance can hinge on chance rather than just intellect and effort, emphasizing the importance of soft skills and mindset in financial decision-making, often overshadowed by traditional approaches. This book offers an exploration of the psychology of money through real-life stories, shedding light on the fundamental role of these soft skills in sound financial choices. Finance education often dwells in formulas and actions, neglecting the influence of psychology in financial decision-making. While healthcare has made strides, the financial sector, encompassing investing and personal finance, paints a different picture. Despite attracting top talents, the financial industry hasn't necessarily cultivated better investors, possibly due to an emphasis on regulations rather than emotions. Money affects individuals deeply, providing insights into human behavior, risk assessment, and contentment. Chapter 1. No one is crazy. Your unique perspective on money is shaped by your background, experiences, and circumstances. The financial choices you make reflect your beliefs and values, which may differ from others who have different journeys and challenges. No one is irrational with money, just different. Your financial mindset is influenced by various factors, such as your generation, your parents, your economic situation, and your personal events. These factors affect how you view and use money, and how you relate to others who have more or less than you. Your financial mindset also evolves over time, as you encounter new situations and opportunities. Your financial path is a result of your individual experiences, which give you a personal view of the world. You have your own goals, expectations, and opinions about money, which may not match those of others who have different backgrounds and experiences. You can learn from and empathize with others, but you should also respect your own perspective. Personal history influences investment decisions more than intelligence or education. Generational experiences, especially in early adulthood, affect risk tolerance and preferences for different assets. For instance, high inflation periods discourage bond investments, while strong stock markets encourage stock investments. Investment success depends on the timing of economic events as well as personal skills. Birth year creates disparities in how people perceive financial markets and assets. Different generations have contrasting views on bonds and stocks based on the economic conditions during their formative years. Different life experiences shape how people view and handle money. Factors such as age, gender, education, race, and historical events can influence one's perception of financial matters and decision-making. Therefore, you should not judge others' choices based on your own assumptions or expectations. Instead, you should try to empathize with their situation and understand their rationale. By doing so, you can learn from their perspectives and appreciate the diversity of financial opinions and behaviors. This will help you become more aware and respectful of the complexity and diversity of financial decision-making. Managing money is complex due to the ever-changing financial landscape. Relying on outdated or oversimplified assumptions can lead to challenges and uncertainties. Instead, learning from diverse money behaviors and choices can provide a more realistic understanding of financial situations and goals, leading to better informed decisions. Chapter 2. Luck and Risk. Luck and risk, like siblings, shape life's outcomes beyond individual effort. NYU professor Scott Galloway stresses the nuanced nature of success, advising against simplistic judgments of achievements. Seize every opportunity that comes your way, especially those that foster learning and skill development. Remember, success is often shaped by a combination of luck and opportunity. Therefore, don't underestimate the power of being in the right place at the right time. It could be the stepping stone to your next big achievement. However, be aware that life is a delicate balance between luck and risk. While you strive for success, remember that risks are part of the journey. Tragic outcomes can occur, even to the most skilled and ambitious among us. So, when evaluating your success and financial outcomes, always acknowledge the influence of both luck and risk. This understanding will give you a more balanced perspective on your achievements and challenges. Recognize the role of luck in your financial success. It's often overlooked, but it plays a significant part. Failures are not always a result of bad decisions. Sometimes, they're the outcome of unforeseen risks. It's challenging to quantify the impact of conscious decisions versus these risks, but don't fall into the trap of seeking simplistic cause and effect explanations. Embrace nuanced analyses instead. Don't let the allure of success stories overshadow the role of luck in achievements. It's tempting to seek replicable strategies, but remember, navigating financial success and failure is complex. It's crucial to understand the interplay between luck, skill, and risk in shaping outcomes, even though it's challenging to pinpoint the true drivers of success. Keep this in mind as you chart your financial journey. In your entrepreneurial and investment endeavors, understand the intricate relationship between risk, luck, and success. The boundaries between audacity and recklessness can often be blurred. It's important to reflect on this as you navigate your path to success. Be aware of the challenges in distinguishing between innovative defiance of norms and criminal behavior in your financial ventures. Discern luck from skill and don't oversimplify outcomes. Recognize the role of risk and luck in decision-making. Adopt a nuanced approach to financial management, focusing on broad patterns of success and failure. Be aware that success can be deceptive, leading to overestimation of abilities. Acknowledge the role of luck and the presence of risk, which can swiftly alter circumstances. Stay vigilant during prosperous times to avoid complacency. Understand that failure can mislead by attributing setbacks solely to poor decisions, overlooking the influence of external factors such as risk. Maintain a balanced perspective on failure and structure your financial affairs for resilience in adversity. By understanding the interplay of luck and risk in both success and failure, remember that forgiveness and self-compassion are essential when evaluating your financial outcomes. Chapter 3. Never Enough. In A Billionaire's Party anecdote shared by John Bogle, Joseph Heller's wise perspective on enough stands out amidst wealth gaps. Heller's insight resonates in a society where we often overlook the idea of having enough. This concept warns us about the risks of insatiable desires, providing valuable lessons on finding contentment and gaining perspective. Your journey to success can indeed be remarkable, but always exercise caution. Be wary of the allure to reach for more, as it can lead to severe repercussions. Remember, the pursuit of wealth can sometimes lead you down a dangerous path, as seen in the cases of those who succumb to greed despite their prior success. These stories serve as a stark reminder of the perils of insatiable desires. Therefore, strive to find contentment, even amidst wealth and prestige. It's not just about how much you have, but also about appreciating what you've got. Avoid excessive risk-taking in your pursuit of more. Remember, jeopardizing what is essential for what is unnecessary can lead to peril. Recognize when you have enough in your financial pursuits. This understanding can save you from unnecessary risks and losses. In a world fueled by social comparison and ambition, resist the trap of constantly raising the bar. The cycle of comparing yourself to those with greater wealth can lead to insatiable desires and potential regrets. Understand that true contentment lies in defining enough for yourself. This can shield you from the pitfalls of relentless pursuit. Striving for more can have dire consequences if not checked. Whether it leads to burnout at work or unethical actions, the relentless pursuit of every dollar can be detrimental. Recognize the value of reputation, freedom, relationships, and happiness. Let these guide you in making prudent decisions and knowing when to draw the line on risky endeavors. Ultimately, safeguarding what truly matters involves acknowledging when you have reached enough. Embrace this concept and avoid unnecessary risks. This way, you can protect your most valuable assets and lead a fulfilling life. Chapter 4. Confounding Compounding. Understand that monumental outcomes can stem from modest beginnings. Just as a small snow base can burgeon into vast ice sheets through compounding effects, your financial growth operates on a similar principle. Incremental progress fuels future gains, showcasing the potential for extraordinary results from seemingly modest origins. Appreciate the transformative power of compounding growth. This saga underscores the profound impact of incremental advancements in realms as diverse as geological epochs and financial endeavors. So, in your journey, remember to value each small step you take. These incremental advancements could lead to significant transformations in the long run. More so, financial success stems not just from investment prowess, but from consistent investment acumen over time. Your financial triumph hinges on the solid foundation you lay in your formative years and the enduring commitment you maintain throughout your life. The real catalyst behind success is the invaluable asset of time, showcasing the profound impact of compounding over extended periods. Although you might be tempted to compare your returns with others, remember that the pivotal role of time in the compounding process can make a significant difference. Embrace exponential thinking over linear thinking. This shift in perspective can lead to paradigm-shifting revelations that challenge conventional wisdom and unlock new realms of possibility in your financial journey. Moving on, technological progress often defies conventional predictions, showcasing the transformative power of compounding. From 1950 to 1990, storage capacity increased by 296 megabytes. However, from 1990 onwards, this growth skyrocketed to a staggering 100 million megabytes. Such exponential progress is a testament to the power of compounding. Be aware that the counterintuitive nature of compounding often eludes even the most astute individuals. Perceptions of technological advancement can lag behind reality, leading to an undervaluation of compounding's potential and a search for alternative solutions. This oversight can inadvertently hinder your progress. Recognize that consistent investing over an extended period underpins the majority of financial achievements. Instead of fixating on short-term gains, the key lies in earning sustainable returns that can be maintained over extended periods, allowing compounding to work its magic. Lastly, focusing solely on chasing the highest returns can be misleading, as such windfalls are often fleeting and unsustainable. True success in investing lies in generating steady, repeatable returns that can withstand the test of time. Straying from this path, pursuing fleeting high returns that cannot be sustained, can lead to unfortunate outcomes. Stay focused on your long-term goals and let the power of compounding do its work. Chapter 5. Getting Wealthy vs. Staying Wealthy. While there are numerous pathways to attain wealth, the enduring preservation of wealth hinges on a blend of frugality and vigilance. It's not just about acquiring wealth, but also about safeguarding and sustaining it. This requires a unique blend of financial prudence and cautious foresight. So, as you navigate your financial journey, remember to balance your ambition with caution. The divergent fates of successful investors underscore a poignant lesson. The journey to wealth acquisition is distinct from the arduous task of wealth preservation. This challenge transcends income levels and resonates with individuals across all financial strata. Therefore, as you strive for financial success, remember to also focus on wealth preservation. It's not just about how much you earn, but also about how much you keep and grow. Survival is the cornerstone of long-term financial success. While the allure of wealth acquisition often takes center stage, the true test lies in your ability to retain and grow that wealth over time. Understand that gaining and maintaining wealth require different skills. Embrace risk-taking and optimism when acquiring wealth, but when it comes to preserving it, humility, frugality, and an acknowledgement of luck's role are paramount. Never underestimate the importance of longevity and the ability to weather economic storms, both in investing and business ownership. Develop a survival mentality, recognizing the unpredictable nature of financial markets and the power of compounding over time. Avoid the pitfalls of excessive debt, panic selling, and attachment to passing trends. Remember the story of Rick Guerin, whose haste to accumulate wealth led to his downfall during a market downturn. Having an edge in investing is futile without the ability to survive and avoid ruin at all costs. So, focus not just on wealth creation, but excel at wealth preservation, a critical factor in long-term financial success. Applying a survival mindset in the real world involves recognizing three key principles. 1. Prioritize financial resilience over high returns. Focus on financial resilience over high returns. Building unbreakable financial strength can lead to substantial returns over time. Holding cash during a bull market, though conservative, can prevent rash sales in a bear market, yielding greater returns. 2. Embrace uncertainty in planning. Acknowledge the uncertainty in planning. Real-world events can disrupt plans, so incorporate flexibility and a margin of safety. This approach enhances survival chances during unexpected challenges. 3. Maintain a balanced outlook. Cultivate a balanced outlook, combining future optimism with a healthy paranoia about potential obstacles. Understand that progress often involves short-term loss, similar to synaptic connections decreasing in the brain to enhance efficiency. Embrace growth amid setbacks to navigate uncertainties with resilience and adaptability. Chapter 6. Tails. You win. Diversify your portfolio and patiently wait for standout investments to emerge. Understand that most acquisitions may hold little value, but exceptional returns from a select few can overshadow any losses. This principle mirrors the influence of long tails in finance, where a small number of events can disproportionately drive overall outcomes. Recognize that success can arise from being wrong a significant portion of the time. Understand the normalcy of failures and the potential for a few key successes to significantly impact overall results. This understanding can help you avoid overreacting to setbacks and maintain a balanced perspective on your investment strategies. Patience and diversification are your allies in the unpredictable world of investing. Understand that challenges are part of the journey to success. Even with numerous setbacks, a single pivotal moment can lead to transformative impact. The success of one significant project can enable the settlement of debts, provision of bonuses to key employees, and acquisition of new resources. Recognize the significance of tail events in driving monumental achievements. These rare occurrences often result in outcomes that are huge, profitable, famous, or influential. This phenomenon extends to various industries where a small number of investments yields substantial returns while the majority may falter. A significant portion of ventures may result in losses, with only a fraction generating exceptional returns that significantly contribute to overall success. Similarly, the distribution of success in large public stocks mirrors this pattern. A substantial portion of stock components may experience significant value declines, with the majority of overall returns stemming from a small percentage of companies that outperform by a considerable margin. This trend transcends industries, so be prepared for substantial value erosion over time. Moving on, to become a part of established indices like the Russell 3000, a certain level of success is required. However, even established corporations can face downturns, as exemplified by Coralco. Despite initial success, many companies face bankruptcy over time. Yet, the overall success of an index is driven by a few entities that excel, offsetting the underperformers. This phenomenon extends to individual companies, where certain exceptional events significantly influence outcomes. The ability to remain composed amidst chaos is a hallmark of success, especially in investing. While much advice focuses on immediate decisions, navigating turbulent times effectively is crucial. Maintaining composure during economic downturns significantly impacts long-term financial success. A disciplined approach during recessionary periods can result in substantially higher returns. Therefore, your success hinges on your ability to navigate moments of crisis effectively, rather than solely relying on steady market conditions. During economic downturns, maintaining composure is crucial as it can have a more significant impact on overall returns than decisions made in times of stability. Acknowledge that failures are part of the process and necessary precursors to significant successes. The path to success involves experimentation and refining ideas, as even being wrong half the time can lead to substantial wealth accumulation. Chapter 7: Freedom. The ultimate form of wealth is the freedom to do whatever you want each day. Seek to increase your wealth not just for material gain, but to enhance your happiness through autonomy and control over your life. The ability to choose what, when, and with whom to do things holds immeasurable value. This autonomy is the most significant dividend money can provide. More than your salary, house size, or job prestige, the ability to dictate your actions, time, and interactions contributes most to personal happiness. Money's intrinsic value lies in granting control over your time, gradually building independence and autonomy. From taking time off work without financial strain to choosing a job with flexible hours or retiring on your terms, money's true power lies in providing the freedom to make choices that enhance your lifestyle. Prioritize freedom over immediate financial gains, as this can lead to a fulfilling and autonomous career path. Despite higher wealth and income levels, happiness doesn't necessarily increase. A significant portion of people experience worry and stress daily, indicating a lack of contentment. While wealth has increased, control over time has been sacrificed. This trade-off between material wealth and time autonomy hasn't led to increased happiness. The focus on material possessions hasn't translated into greater well-being. The shift in job types towards decision-making roles and service-oriented professions has blurred the lines between work and personal time, contributing to a feeling of working around the clock. As control over time diminishes, it's crucial to understand what truly brings happiness. Quality relationships, meaningful connections, and spending unstructured time with loved ones are important. Time control is a key factor in overall well-being, highlighting the value of personal experiences over material wealth. Chapter 8: Man in the Car Paradox. You might be drawn to the allure of luxury cars, seeing them as symbols of success and status. But remember, the admiration you seek is often not for you, but for the car you drive. People may not genuinely admire you for your wealth, but rather use it as a benchmark for their own aspirations of being liked and esteemed. The desire for an expensive car, a lavish watch, or a grand residence is not what truly fulfills us. What you genuinely crave is respect and admiration from your peers. You might mistakenly believe that acquiring expensive possessions will automatically command such regard. However, this is rarely the case, especially from those you most desire recognition from. While material possessions may seem to enhance respect and admiration, true respect and admiration stem from qualities like humility, kindness, and empathy. These qualities hold far more value than mere displays of wealth. So, while it's not wrong to pursue wealth or luxury items, remember that they are not the ultimate sources of respect and admiration. Chapter 9: Wealth is what you don't see. True wealth is often hidden, not in the material possessions we see, but in the choices not made, the cars not bought, the jewelry not acquired, and the first-class upgrades declined. It lies in financial assets not yet converted into visible items. In a society where appearances often dictate perceptions of success, it's easy to misjudge wealth based on outward displays like expensive cars or lavish homes. However, true wealth is about income not spent, offering options and growth for the future. The distinction between being rich and being wealthy is crucial. While richness may be evident in current income and visible possessions, true wealth is the accumulation of assets through disciplined spending and saving. Learning about wealth is challenging because it is often concealed. Unlike richness, which is easily displayed, wealth is a more discreet form of success that requires restraint and long-term planning. People are inclined to seek respect and admiration through material possessions, but true admiration often comes from qualities like humility, kindness, and empathy, rather than flashy displays of wealth. In a world where financial success is often equated with visible indicators, it is essential to recognize that wealth is what remains unseen, the financial security and freedom that come from prudent financial decisions. Chapter 10. Save money. Prioritize saving money. It's a crucial task, especially if you doubt your ability to save or underestimate the importance of saving. Remember, wealth accumulation is less about income or investment returns and more about your savings rate. Efficiency plays a significant role in this process. Just as the 1970s energy crisis was mitigated by enhancing energy efficiency, your financial well-being can be significantly impacted by personal savings and frugality. Wealth is not solely determined by income or investment prowess. It's relative to your needs and how efficiently you manage your resources. Even if someone earns higher investment returns, their financial well-being may be overshadowed by someone who is more frugal and content with less. This underscores the importance of controlling expenses and maximizing the value of your savings, as it ultimately determines your financial success and security. So, make wise decisions to save and spend, as these are within your control, unlike the uncertainties surrounding investment returns. Save money for saving's sake. In an unpredictable world, savings are your hedge against the unforeseen. Beyond financial security, saving without a specific spending goal empowers you with control over your time. It provides flexibility to wait for favorable opportunities and make decisions on your terms. Each dollar saved is future potential reclaimed. In today's competitive global landscape, flexibility is more valuable than just intelligence. With automation rising, soft skills like communication and empathy are paramount. Flexibility allows you to upskill, find your niche, and optimize opportunities at your own pace. Saving money grants you the freedom and resilience to navigate life's uncertainties with confidence. Chapter 11. Reasonable greater than rational. You are more than just numbers. You are a complex, emotional person. In finance, strive for reasonable decisions that align with your behaviors, not just cold rationality, like the doctor who used malaria to treat syphilis. Challenge conventional wisdom if it leads to breakthroughs. Though risky, his innovation balanced rationality and reasonableness, earning a Nobel Prize. Similarly, prioritize practicality and emotional well-being in your financial choices over logic alone. This resonates more with your values, leading to greater long-term success and satisfaction. By embracing reasonableness, you can make sound financial decisions for your unique situation. Aim for financial strategies that prioritize your peace of mind, not just mathematical optimization. Like Nobel winner Harry Markowitz, diversifying to minimize future regret. Make decisions that resonate emotionally, not just rationally. Consider social dynamics and personal relationships. You're human, not a calculator. Favor simplicity over complex data models. While leverage may look good on paper, market volatility could be emotionally devastating. Technical truth doesn't equal contextual sensibility. Rationality has a place in finance, but reasonableness attuned to your values and relationships leads to more sustainable, fulfilling outcomes. Seek strategies that make sense for your life holistically. Passion for your investments can provide an advantage. While detached rationality is prized, lack of emotional connection may cause you to abandon strategies when challenged. If you have a genuine affection for your approach, you're better equipped to persevere. Commitment during tough phases strongly correlates with performance. Do what you love applies to finance too. Investing without passion risks disinterest and premature exiting when faced with losses. Enthusiasm for a company can motivate you to weather difficult times. It's acceptable to be reasonable over strictly rational sometimes. Home bias for local companies seems irrational but provides comfort supporting your community. Though risky, activities like stock picking in moderation driven by interest can complement diversification. Making predictions satisfies the human desire to anticipate trends, even if acting on them is risky. Like Jack Bogle championing indexes yet investing in his son's funds for family, inconsistencies show the multifaceted nature of finance. Rationality matters, but personal factors hold significance too. Chapter 12. Surprise. Things that have never happened before happen all the time in the economy and investment markets. Don't fall into the historians as prophets trap, where you overly rely on past data to predict future conditions, especially in fields characterized by innovation and change. While it's wise to value economic and investing history for setting expectations, highlighting common pitfalls, and offering broad guidelines on effective strategies, don't misconstrue history as a crystal ball for foreseeing a future. Unlike hard sciences, decisions in finance are made by a diverse group of individuals with imperfect information, leading to emotions like anxiety, greed, and paranoia influencing their choices. Understand that economics underscores the inevitability of change over time. The market abhors prolonged stability and favors fluctuations. The narratives people construct and their evolving preferences for goods and services are pivotal in financial matters, constantly shifting with cultural and generational changes. Don't excessively revere individuals with past experiences in finance, as such experiences do not guarantee accurate predictions of future events. Overconfidence often stems from past successes, hindering the ability to adapt to new circumstances. Lastly, remember that merely studying or living through historical events may not offer a reliable guide for navigating future market conditions. The complexity of financial markets necessitates a nuanced approach that acknowledges the limitations of historical analogies in predicting future outcomes. Stay adaptable and open-minded. Be cautious about relying excessively on investment history as a roadmap for future outcomes. This approach can lead to overlooking outlier events that have the most substantial impact on the economy and stock market. Outliers, such as the Great Depression, World War II, the dot-com bubble, September 11th, and the mid-2000s housing crash, trigger cascading effects across various sectors. A handful of individuals or events can drastically alter the global economy and societal norms. Pivotal projects, innovations, and events have had monumental repercussions on the world stage. Despite the countless projects and events that transpired in the 20th century, a select few have wielded unparalleled influence on global affairs. These tail events are often underestimated due to the compounding nature of their effects. Avoid using historical outliers as benchmarks for worst-case scenarios in forecasting future investment returns. These unprecedented events lacked precedence when they unfolded, challenging the assumption that past extremes will necessarily mirror future outcomes. Don't fixate on historical outliers as templates for future projections, as this approach inadvertently disregards the potential for unforeseen events to shape the future economic landscape. Recognize that change is a constant in the investment landscape. It's not so much about what caused the change, but the fact that change indeed occurred. Take note of the insights from Benjamin Graham's seminal work, The Intelligent Investor. While it offers practical guidance and formulas for making sound investment choices, understand that not all of these formulas prove effective in today's market environment. Be aware that strategies like purchasing stocks trading below their net working assets or avoiding stocks trading above 1.5 times book value may not align with modern investment strategies. Don't strictly adhere to published formulas, as they may not guarantee substantial success. Instead, continuously experiment, retest assumptions, and seek out what truly works in the current market landscape. Acknowledge that old methods may no longer be as effective and be open to new ones. More so, understand that the detailed analysis of individual stocks may no longer be the most effective approach in today's rapidly changing financial environment. Look at recent history as it often provides a more relevant guide to the future, considering the evolving economic conditions and market dynamics. Learn from the history of money to understand enduring aspects like human behavior in financial matters, responses to incentives, and reactions to stress. Chapter 13, Room for Error. In financial management, it's crucial to understand that you're playing a game of probabilities, not certainties. Just like blackjack players who count cards, you need to acknowledge the inherent uncertainty of future outcomes and adapt your strategies accordingly. This means monitoring your environment, assessing the likelihood of specific events, and adjusting your actions based on the odds. Remember, the effectiveness of any strategy lies in slightly shifting the odds in your favor, not in achieving absolute certainty. However, even when the odds appear favorable, avoid overbetting. Excessive betting can lead to substantial losses if predictions go awry, potentially depleting your resources and hindering further progress. The world does not consistently favor any individual, so always allow room for error and prepare for deviations from your intended plan. Maintain a sufficient financial cushion to withstand fluctuations of bad luck. For instance, if you have a modest 2% edge over a situation, it's advisable to have a buffer to endure adverse swings. The key to navigating uncertainties is widening the gap between anticipated outcomes and potential outcomes while ensuring the ability to persevere and continue the fight another day. Keep these lessons in mind as you navigate your financial landscape. Navigating the financial world is a game of probabilities, not certainties. Precise forecasting is challenging, whether it's predicting market returns or retirement dates. It's essential to acknowledge the gray area of potential outcomes and the inherent uncertainty in financial decisions. Don't underestimate the importance of room for error. It's not just a conservative approach. When used effectively, it allows you to endure a range of outcomes and increases the odds of benefiting from low probability events. Maintaining ample cash reserves to withstand uncertainties is crucial. This strategy, exemplified by successful individuals like Bill Gates and Warren Buffett, underscores the value of room for error in financial strategies. When planning for financial goals like retirement, consider volatility and emotional resilience. Spreadsheets can provide numerical insights, but they fall short in capturing the emotional impact of investment decisions. By incorporating room for error in estimating future returns, you can enhance your financial preparedness and mitigate potential disasters. Remember, the goal is not to render forecasts unnecessary, but to navigate a world governed by probabilities with confidence and resilience. Pursue desires indefinitely with resilience. Embrace room for error to endure unforeseen challenges. Learn from the unexpected, like plans derailed in the Battle of Stalingrad. Avoid single points of failure. Create financial redundancy beyond your paycheck and known goals to prepare for field mice. Ensure robust margins of safety. Anticipate unknowns and have backup plans. Chapter 14. You'll change. Achieving your dreams requires an unmatched work ethic and the ability to defy expectations. However, it's important to remember that success doesn't always bring satisfaction. Overwhelming stress and long hours can take a toll on you. People are often poor predictors of their future selves, and while envisioning goals is exciting, the practical life challenges that accompany ambitious pursuits can present a different narrative. Your initial dreams may not align with your evolving values and priorities. Life's complexities, such as demanding work hours, family responsibilities, and financial considerations, can lead to unforeseen career transitions and lifestyle choices that impact long-term financial planning. Acknowledge the fluidity of your personal goals and desires. Prepare for the future, but recognize that both external circumstances and internal aspirations evolve over time. Flexibility and adaptability are key in crafting a financial plan that can withstand the dynamic nature of life's journey. Recognize that you're susceptible to the end of history illusion, a tendency to underestimate future shifts in your personality, desires, and goals. Decisions made at each life stage profoundly impact who you become, often leading to unforeseen outcomes and regrets. This illusion can manifest in various aspects of life, such as removing tattoos you once cherished or undergoing divorces that contrast your initial marriages. Don't assume that your personal history culminates in the present, shaping a static future self. Aspirations and priorities evolve over time, posing challenges for long-term financial planning. While some achieve success by maintaining consistency over decades, significant personal growth may lead you to desire change. Instead of envisioning life as a single 80-year journey, consider it as 4 distinct 20-year blocks, each potentially requiring different financial strategies. Navigate the complexities of financial planning amidst evolving life goals. Balance extremes in financial decisions to avoid future regrets. Strive for moderate annual savings, balanced free time, a reasonable commute, and adequate family time at different life stages. Endurance and adaptability are key in fostering financial resilience. Considering the inherent tendency for individuals to transform over time, expect your preferences to change. Youthful job choices often don't sustain fulfillment. Embrace the end of history illusion, slim odds of lifelong satisfaction from early selections. Adapt via informed decisions aligned to evolving aspirations. Reevaluate old financial goals without attachment. Minimize regrets by abandoning outdated aims and avoiding sunk cost traps. Stay flexible to focus on rewarding pursuits. Recognize changing course maximizes potential. Chapter 15. Nothing's free. The world is not always benevolent. There exists a cost that must be reckoned with. In this context, the market serves as a relentless provocateur, offering substantial gains only to swiftly retract them. For instance, considering dividends, the Dow Jones Industrial Average boasted an impressive annual return of approximately 11% from 1950 to 2019. However, the price of prosperity during this era was notably steep, as indicated by instances when it fell at least 5% below its prior peak. This phenomenon exemplifies the inherent cost of market returns, a fee that must be paid for participation, often accompanied by discomfort. Analogous to many commodities, the greater the returns, the more substantial the price. Notably, stocks like Netflix and Monster Beverage yielded remarkable returns over specific periods, such as 35,000% and 319,000%, respectively. Despite these exceptional gains, they frequently traded below their previous peak values, underscoring the challenging nature of sustaining high returns in the market. When it comes to investing, you have several choices. You can embrace volatility and uncertainty, opt for an asset with lower risk and reward, or attempt a risky maneuver, striving for returns while evading market fluctuations. However, trying to achieve returns without bearing the true cost often leads to repercussions. Tactical mutual funds, which aim to switch between stocks and bonds opportunistically, often exhibit higher volatility and comparable downside risks to the passive index. Individual investors often underperform due to excessive buying and selling instead of adopting a buy and hold strategy. This is akin to trying to avoid the price, only to end up paying double. Companies like General Electric and mortgage giants Freddie Mac and Fannie Mae have manipulated figures to shield shareholders from the true costs, providing them with stability and predictability. However, when the reckoning arrives, substantial losses that were previously concealed through accounting maneuvers are endured. Always remember, enduring the associated risks is crucial when seeking rewards. Understand that the cost of successful investing is not immediately apparent. When the bill for investing comes due, it may feel more like a penalty for wrongdoing rather than a fee for obtaining something valuable. However, perceiving market volatility as a fee, not a fine, is crucial for cultivating the mindset necessary to endure until investment gains materialize. Just as you have the choice to visit Disneyland or a local fair, you can opt for low-fee investments like cash and bonds. But to access higher returns, you must pay the volatility and uncertainty fee, the price of admission to potentially greater rewards. The key lies in convincing yourself that the market's fee is justified. This mindset is essential for effectively managing volatility and uncertainty, not merely tolerating them but recognizing them as a worthwhile admission fee. While there are no guarantees, occasional setbacks akin to rainy days at Disneyland may occur. Yet, if you perceive the admission fee as a fine, you risk missing out on the magic. Therefore, identify the price and be prepared to pay it. This approach will help you navigate the complexities of the financial market and maximize your investment returns. Chapter 16. You and Me. Financial bubbles, such as the dot-com and housing bubbles, have profound social impacts and can devastate lives. While greed is often pointed to as the cause, it's essential to remember that financial decisions are often made based on limited information and seem sensible at the time. Bubbles don't resemble a straightforward diagnosis. They're more like the complex rise and fall of a political party, with known outcomes but contentious causes and accountability. In investing, every asset has an owner due to fierce competition for returns. This makes the concept of bubbles contentious, as no investor wants to believe they hold an overvalued asset. One overlooked reason for these phenomena is that investors often unknowingly take cues from others playing a different investment game. The prevalent notion in finance that assets possess a single rational price in a world where investors have diverse goals and time horizons has led to significant harm. Your individual circumstances, whether you're planning for the long term or seeking short-term gains, influence what you perceive as a reasonable price for an asset. Remember, capital tends to flow towards opportunities offering the highest returns. When an asset shows consistent upward momentum, it's natural for you, as a short-term trader, to anticipate further price increases within your desired time frame. This dynamic can attract more short-term traders like you, leading to a shift in the investor base from predominantly long-term to predominantly short-term participants. This shift can fuel a self-reinforcing cycle where escalating short-term returns draw in additional traders like you. However, be aware that this shift can lead to market dynamics being increasingly influenced by individuals with shorter time horizons, rather than those focused on long-term investment strategies. The emphasis can shift from traditional valuation metrics to the time frames of market participants. This was evident during the dot-com bubble era and the mid-2000s housing bubble, where investors were more concerned with immediate gains rather than long-term prospects. So, while chasing short-term performance metrics, don't lose sight of the importance of adopting a long-term perspective and sustainable investment strategies. Moving on, financial bubbles often arise not from irrational long-term investment decisions, but from individuals making rational moves towards short-term trading to capitalize on self-reinforcing momentum. When there's significant potential for short-term returns, it's natural for you to want to seize the opportunity. However, remember that this can lead to a disregard for traditional long-term investment principles, especially concerning valuation. Problems emerge when you, as a long-term investor, start taking cues from short-term traders pursuing a different approach. It's crucial to understand the rationale behind others' actions before making investment decisions based on their behavior. Recognize that different investors have distinct goals, and being influenced by those playing a different game can distort your financial decision-making. Understand your own time horizon and avoid being swayed by individuals playing different games. By aligning your investment approach with your goals and values, you can stay focused on your long-term objectives. Chapter 17. The Solution of Pessimism. Pessimism often prevails over optimism, carrying an air of intellectual sophistication and garnering more attention. However, you should remember that optimism is often the wiser choice. True optimists don't naively believe that everything will always be perfect. Instead, they believe that favorable outcomes are probable in the long run, despite inevitable setbacks. Optimism is based on the notion that most people strive each day to enhance their circumstances and contribute positively, even during challenging times. Pessimistic forecasts tend to dominate the narrative. However, it's important for you to understand that extreme optimism is rarely granted the same level of credibility as doomsday prophecies. This disparity underscores society's inherent bias towards narratives of impending doom over those of boundless optimism. So, while it's acceptable to harbor concerns about the future, remember to maintain a balanced perspective and not let pessimistic outlooks overshadow the potential for positive outcomes. Pessimism often holds more sway than optimism, capturing attention and credibility. Predictions of doom and disaster attract more interest and belief, even when presented by less credible sources. Whether it's stock market predictions or forecasts of economic recession, warnings of negativity tend to overshadow positive outlooks, garnering more attention and recognition. Despite significant historical growth in various fields, including finance and social equality, pessimism continues to dominate perceptions, overshadowing the true progress that has been made. The enduring appeal of pessimism, as highlighted by historical figures like John Stuart Mill, is deeply rooted in human psychology and evolutionary instincts. Our tendency to prioritize avoiding losses over seeking gains, coupled with the far-reaching impact of negative events in the financial realm, contributes to the prevalence of financial pessimism. While positive developments may go unnoticed, economic downturns prompt widespread concern and vigilance due to the universal influence of money. Recognizing the allure of pessimism in shaping perceptions of finance is essential in navigating the complexities of the financial landscape. The surge in oil prices and the subsequent innovation in extraction technologies emphasize the transformative power of market incentives and technological advancements. As highlighted by Daniel Yergin, the majority of U.S. oil reserves are a result of technological improvements rather than initial estimates, demonstrating the crucial role of innovation in shaping industries. The rise of fracking, in particular, led to a substantial increase in oil production, showcasing the adaptability of markets and technology in shaping the economic landscape. While pessimistic forecasts may seem convincing, they often overlook the dynamic nature of the world and the adaptability of markets and technology. History has shown that setbacks are addressed and progress unfolds gradually, underscoring the resilience of the economy and society. Just as the Wright brothers' invention of the airplane was initially dismissed but later recognized as transformative, optimism about long-term advancements requires a broader historical perspective. By embracing a more optimistic and forward-looking approach, individuals can recognize the potential for progress and transformation amid initial challenges. Chapter 18: When You Will Believe Anything. Recognize the power of narratives in shaping economic realities. The stories we tell ourselves can either propel growth or impede progress. The most significant changes often aren't in the tangible aspects of the economy, but in these narratives. Despite visible prosperity, a shift in narrative can lead to severe economic repercussions. In managing your personal finances, it's essential to understand the impact of these narratives on financial decisions. This understanding allows you to navigate the complexities of the economy with greater insight and foresight. So, stay informed, stay aware, and always question the narratives that influence your financial behavior. Desires can make us embrace unrealistic narratives, like believing wars were over after WWI, though we followed. This clinging to appealing fictions heavily sways financial views. They arise when facing limited control and high stakes. In dire situations, dubious solutions seem plausible, like folk remedies in plagues. In investing, potential life-changing rewards, despite low odds, led people to unreliable advice aligned with wishes. Abundant conflicting opinions further entrench desired beliefs over realistic probabilities. Recognize how high stakes and uncertainty anchor in realistic hopes, shaping financial decisions. Incentives shape financial perspectives. Recognize their influence. They can distort reality. In high-stakes finance, margins for error are huge with incomplete knowledge. Like children filling gaps with limited facts, we construct narratives. Desires for predictability and control fuel reliance on forecasts despite inability to accurately predict markets. Turning to authoritative figures offering certainty satisfies emotional need for order, not analytical soundness. Recognize the stories we latch onto that convey mastery over complexity. Understand that precision in fields like astrophysics doesn't translate to finance, business, or economics. These areas are riddled with uncertainty, primarily driven by decisions that defy simple explanations or formulas. Despite the allure of having complete control over outcomes, it's crucial to remember that human behavior and emotions introduce unpredictability that can't be precisely calculated or predicted. When planning for the future, avoid focusing solely on your capabilities and intentions. External factors can significantly influence outcomes. Overconfidence in your beliefs and underestimation of the role of luck can lead to unrealistic expectations. Remember, the success of ventures isn't determined solely by your efforts, but also by competitors' achievements and market dynamics. Constructing narratives based on limited knowledge can lead to a false sense of control and understanding. Stay aware of external influences and uncertainties to maintain a realistic perspective. Chapter 19: Altogether Now. Financial advice, like medical practice, is complex and requires a deep understanding of unique circumstances and objectives. While there are fundamental principles in financial management, the interpretation and application of these principles may vary based on personal goals and values. Historically, professionals in fields like medicine believed their duty was solely to cure, with little regard for the patient's input. However, modern practices emphasize shared decision-making and respect for diverse perspectives. Apply this patient-centric approach to your financial decisions. Remember, sound financial choices are empowered by considering various perspectives and making informed decisions. In prosperous times, embody humility, and in setbacks, extend forgiveness and compassion. Situations are rarely as extreme as they seem. Respect the influence of luck and risk, and focus on what's within your control. Adopt a mindset of less ego, more wealth. Save money to bridge the gap between your desires and income. Sacrifice immediate gratification to secure future opportunities. Accumulate wealth by curbing impulsive spending. Tailor your financial approach to promote peace of mind. Align your financial decisions with your personal comfort and security. Extend your investment time horizon for enhanced success. Accept the inevitability of setbacks and uncertainties. Evaluate your financial performance holistically, focusing on your entire portfolio. Use your financial resources to reclaim control over your time. Prioritize saving, irrespective of specific goals. Be prepared to pay the inherent costs of success. Maintain a margin for error in your financial strategies. Chapter 20. Conclusions. When making financial decisions, consider what works best for you and your family. It's not just about maximizing returns, but also about minimizing the risk of disappointing loved ones. Tailor your financial strategies to suit your personal needs and goals. Your primary financial objective should be independence, not amassing wealth or living extravagantly. Independence is about having the freedom to choose fulfilling work, with whom, and for how long. Maintain a lifestyle below your means. This can lead to a higher savings rate and a sense of contentment without feeling excessively frugal. Keep your lifestyle desires constant over the years to prioritize your goal of independence and avoid societal pressures. This approach may not be suitable for everyone, but it can be a source of peace of mind and a way to break free from the rat race. Own your home outright, even if it seems illogical from a financial standpoint. The sense of freedom and independence you gain surpasses potential financial gains from leveraging assets with a mortgage. Don't justify your decisions to others or conform to conventional financial advice. What matters most is that your choices work for your well-being and happiness. Maintain a higher percentage of your assets in cash than what most financial advisors would recommend. View cash as essential for independence, ensuring that you never have to sell your stocks unexpectedly to cover unforeseen expenses. Consistently invest in a low-cost index fund through dollar cost averaging for the best odds of long-term success. Your approach to finance should revolve around the pursuit of independence and financial security, ensuring that you can sleep well at night knowing you are on track to meet your goals. Why U.S. consumers think the way they do. In the postscript section, the author provides a brief history of why the U.S. consumer thinks the way they do. The author explains that the consumer behavior and attitudes towards money are shaped by cultural and historical factors such as the country's founding principles of individualism and self-reliance. These principles influence how Americans view their economic responsibility and help to explain why many Americans tend to value financial independence and are resistant to redistributive policies. He also highlights how events such as the Great Depression and the Vietnam War have shaped Americans' values. For example, the financial struggles of the Great Depression and the post-war period instilled a sense of frugality and thriftiness in many individuals. These values have subsequently influenced many Americans to prioritize saving and investing, as opposed to conspicuous consumption. Moreover, the author goes on to discuss how the American capitalist system has reinforced the idea that wealth accumulation is a symbol of success. Americans' high levels of consumerism are seen as a result of this system, with individuals pursuing spending and acquiring material goods to display success and to attain social status. This materialistic society has been further aided by access to credit, enabling individuals to acquire material goods they couldn't afford through in their savings or income. Finally, the rapid digitization, technological advancements, and growth of social media have changed the ways Americans perceive and think about money. With the rise in celebrities, influencers, and social media influencers showcasing their lifestyles, many Americans have become obsessed with maintaining their own lifestyle standards and status symbols. In some cases, people have come to measure their success and self-worth based on comparisons to these social media influencers. Generally, the U.S. consumer behavior and attitudes towards money are multifaceted and shaped by historical, cultural, and socioeconomic factors. These factors will continue to mold the ways Americans think and act about money, creating different views about investment, spending, and saving.